Good afternoon, everyone, and welcome to the latest webinar in our Feast of Ideas for Your ISA event. This week has an emerging market theme, and shortly we'll be discussing China, the most important emerging market for multiple reasons. Very shortly, I'll be handing over to Ben Buckler. Ben is a China investment specialist and chair of the China product group at Baillie Gifford, and he'll be talking to us about the Baillie Gifford China Growth Trust. Before we start, just a reminder that we have roughly half an hour for the presentation and then 15 minutes or so for questions. If you would like to ask Ben a question, please put the question in the box to the right, and I will put those questions to Ben at the end. So with that, Ben, I will hand over to you.
Brilliant. Thank you, Thomas, and thank you to everybody who has joined over their lunchtime. Much appreciated. And I hope it's going to be a fascinating 45 minutes on all things China, and perhaps even challenging in certain areas. But my plan is really to try and deal with the big picture elements of China first, and I'll come back towards the end just to try and look at the trust itself and really the opportunities there. But for context, I think it's maybe worth just trying to start with what it is that we're trying to do here. I think those that listened in to Ed yesterday lunch will have heard the sort of macro story for emerging markets and for China. For Baillie Gifford, we're very much driven by a small number of exciting companies that China is producing. So it's great to hear the positive story and the macro tailwinds that we've got. But there are also companies out there who are involved in long-term structural growth themes. And they don't really care about whether or not inflation or interest rates are going up or down, or whether China grows at 4% or 6% this year. And that's really where we're focused. In total, there are over 6,000 listed Chinese companies. And with the trust, we're focused just on 40 to 80 of them. Key to all of our investments is really the long-term philosophy that we bring, and that stands in stark contrast, we think, to the time horizons of the local market. And you really look for different things and ask different questions if your time horizon is 5+ years, rather than 5 months, which is really what it is, the holding period in the domestic A-share market, for example. And that time horizon really informs where we look for our information for people that have similar time frames as us. And that leads us more to people like academics, industry specialists, and private companies who are effectively building the long-term futures, rather than traditional finance, who often struggle to think more than sort of 12 months and beyond. It's also our firm belief that delivering long-term capital returns really requires being involved in disruptive and secular trends. And those trends play out over years and decades. They don't play out over months and quarters. And sometimes that means that our focus on company fundamentals is going to look out of line with where the market is focused when it's focused more on those macroeconomic indicators. But we also know from our history that those excess returns accrue to the companies that are in the top quintile, the top 20% of earnings growth. And we're happy to accept the inevitable short-term volatility on the path to those long-term returns. But we do know that that can sometimes be challenging over the short term for investors. I mean, as we all know, over the last couple of years, it's not been the easiest time for investors in China. And for all the positives of both the size of China's markets and the speed of its development, China continues to polarize investment views and comes with comments about poor governance, a lack of reform, certainly a skepticism about its politics, and then increasingly, obviously, more about the geopolitics. And I'll come back to trying to deal with that. For those sort of reasons, I think that's why we think it's important to be able to balance global perspectives as well as local insights. And at Baillie Gifford, we have an office in Shanghai with investors over there that can help us navigate these things in a number of ways. But also being in Edinburgh allows us just to get away from a lot of the noise, to think about the big structural shifts that are going on in the world. I think, we think that balances the perspectives whilst also being able to bring a notable challenge to our way of thinking. And we've learned this over 30 years of investing in China with a long-term lens, that often broad generalizations about China as an asset class or China as an economy as a whole can be quite unhelpful. And hopefully over the next 20, 25 minutes, I can try and explain why I think this is the case, and then to some extent, really how that provides us with the opportunity that we see for the trust. First, I thought it'd be worth trying to unpick the big changes that we've seen in China recently. And I think market sentiment has been incredibly fickle. And if we go back just 6 months, you had headlines denouncing the demise of the asset class as being uninvestable. And suddenly that's now been replaced by frantic calls to reposition oneself for this great reopening that is expected over the next year. It's fair to say that outside of China, we tend not to hear as many of the positive stories. And we go back just 6 months to the Party Congress in October, when things seemed particularly negative out there. You know, a lot of the discussion we heard was about zero COVID, was about the makeup of the Politburo. But Western media typically forgot to mention the first half of Xi Jinping's speech, which effectively dealt with growing the economy, focusing on sustainability, productivity, rural development, and then sort of consequently support for the, you know, the large domestic opportunities that were coming in key sectors. So I think against a lot of that background, it's important to try and remain level-headed and look through a lot of the noise. You know, yes, Xi Jinping is looking to kickstart the economy this year. Yes, the near-term macroeconomic outlook is fairly positive. But in the back of our minds, we also need to remember that Xi Jinping's long-term vision hasn't changed, and those signature policies, things like common prosperity, dual circulation, will remain. That's really why, for us, our goal is to identify those long-term structural themes and then the companies that benefit from that. That's why the right-hand side of this slide is trying to pick out what that opportunity really is. If we take, you know, the opportunity here and define big winners, you know, these companies that can grow their earnings by 15% a year or more over a 5-year period, then China has delivered 17% of those companies in the global context. I'm going to come back to talking a lot more about the opportunities, because that's what gets us excited. You know, at Baillie Gifford, we're much more about the bottom up. But, you know, what I want to acknowledge, I think, first is what we've seen in the last couple of years, those risks of investing in China, and has, you know, impacted how we think, but also how we as active, engaged and long-term managers try to mitigate those. Even though, I guess, that focus on the bottom up, I think it's helpful to talk about those macro concerns, because I think that's where most of the questions are likely to come from at the end. And I thought it would be helpful to pick on 3 in particular that have really impacted certainly 2022. The first being zero COVID and China's approach to lockdowns that have had negative economic implications. The second is regulation and the growing risk or perceived risk that the private sector is being undermined by greater government influence. And then finally, the Politburo, the makeup of the Chinese government, and the fact it was effectively filled with loyalists to Xi Jinping that raises these policy risks and has given concerns around rising ideological influence. So dealing with those 3 and starting with COVID, because clearly since 6 months ago, the outlook here has changed hugely. And albeit acknowledging, sadly, the human toll, as most countries around the world have seen when coming out of COVID, you know, China is now through the worst and starting to look at an economic recovery that the rest of the world has already been seeing for the last 18 months. And you know, just 2 weeks ago, I was back over in China for the first time in 3 years, able to meet our investors on the ground there. And albeit still at the start of this recovery, you do get the sense that things are getting back to normal and starting to have economic benefits. It's also the way that the government dealt with COVID is an example of how quickly that they can actually move. And you could argue almost too quickly in the context of preparedness for opening up. But one of the big risks that the market was concerned about was really that the Politburo would take an ideological shift to the left, would be very slow and not pragmatic when responding to problems with the economy. And clearly what we've seen is just how decisive the government have been able to act and how swiftly they've been able to remove one of the key detractors to economic growth. So on that front, rather than worry about lockdowns, the market is now talking much more about the impending consumption-led recovery. And I think, well, that does stand China in stark contrast to many economies around the world that are now looking at recessions this year. If I take the second factor of that one, and this is really regulation, we tend to try to think of this much more in terms of a pendulum. You know, the idea that historically in most industries over most timeframes, you know, innovation and regulation go hand in hand. And particularly in the internet space, which is where much of this has really been delivered in China over the last 2 years, you've seen a decade of effectively unrestrained growth in key areas of the economy. You know, data, 5G, e-commerce, you know, all things digitization. To the point at which, as Xi Jinping sort of noted, there's a requirement to prevent the disorderly expansion of capital. And it is worth remarking upon just how lax regulation was over that decade. And for us at Baillie Gifford, much of what we've seen in terms of this regulation is pretty sensible. We know that many people think regulation is a dirty word and it can often impact short-term earnings. But if we just try and think through what they're trying to constrain here, monopolistic behavior, ensuring competition remains vibrant, consumers are protected, we think these are good for the consumer, good for competition, and therefore good for the long-term sustainability of these industries. And one of the reasons that China has had to regulate arguably faster than others is the fact that its companies are developing far faster than others. And again, that is both an opportunity and a risk. I'm guessing, you know, all of us here use Amazon, and my sense normally on a daily basis, but Amazon makes up 13% of total global e-commerce sales. Alibaba in China makes up 29% of global e-commerce sales. If we look at the payments business and Ant Financial, currently unlisted but owned by Alibaba, in terms of payment numbers, it went from 0 to having more than Visa and MasterCard put together in under 3 years. Or we could look at something like e-commerce company or social e-commerce company Pinduoduo. The company was only founded in 2016 and today has 880 million users. So that's arguably why China's had to regulate far faster, because these kind of companies are really pushing the edges of development and innovation, and China's leading there. You know, acknowledging the challenge of regulation, though, is trying to understand this top-down system of governance, which delivers broad guidance that allows for this element of innovation, this element of competition, but often brings with it a huge communications problem. You know, in practice, what you see is the leading Politburo or ministers suggest that there's a problem and we need to regulate in certain areas. That results in hugely overzealous response by each of the individual ministries, who are all proving themselves to their boss that they can regulate harder and faster. In turn, that delivers unintended consequences, and as we've seen, the slowing in the economy has hit quite hard in the last couple of years. That then returns back to Beijing, who clarify what they really meant, and the pendulum swings back towards the market and away from the state, and that's exactly what we've seen in the last 6 months. And even sort of in contrast, I think, to the last 2 years, the anti-monopoly regulator doesn't even mention internet companies in the 2023 plans. So again, one of the big headwinds for an important part of the portfolio has been removed, but we'd also say it's been removed for now. You know, we should, as investors, expect periods in the future where that balance between the market and the state becomes unstable. We should expect periods of volatility caused by abrupt changes in regulatory norms. But on the other side of that, we should also expect continued pragmatism and a willingness to roll those regulations back and those policies back when they don't end up contributing to China's long-term goals. One of the ways we at Baillie Gifford try to deal with that is to continually refer to what is our very first question in our analytical process for the trust. And this is asking whether or not the company contributes to or benefits from China's economic, social, or cultural development. That's just how important we think that being aligned with the goals of the Chinese state are when you're investing in China. That seems to me to be quite a good point to shift on to the role of the state. And one of the other big worries coming out of that October Congress was just the Politburo being filled with loyalists that would see the shift towards greater state involvement in the economy. I think it's fair to say for most of us, the risk of a policy misstep has risen because of the lax checks and balances. And to some extent, that is most likely going to play out in the geopolitical sphere and the tensions we see that. But I think a lot of commentators just stop there and looking at the negative side of this. I think we also want to reflect some of the benefits that might come from this new setup. Now that you've removed the different internal factions within the Politburo, you've effectively opened up lines of dialogue for far more effective challenge, as well as a faster speed of response. And that's really what we've seen so far with both COVID and the property sector, and increasingly with the private sector as well. Before I come back to the private sector, I'm just going to deal with geopolitics. I'm sure we'll get more questions on this later on. I think this is clearly a critical challenge, and we have two world powers with opposing worldviews, and we don't expect that that situation is going to change or materially improve in coming years. And therefore, at times, we're going to expect it to lead to some quite uncomfortable situations. We believe that our risk assessment, therefore, needs to be fairly dynamic around that. And we can see with things like the West's response, or the unified response to what we've seen in Ukraine, to how China views Taiwan, supply chain dynamics, and arguably growing distrust of China more broadly. All of these are going to play a role in years to come. Some of these are clearly low probability but high impact events, but we clearly need to be aware of those risks, but just be able to balance those with the scale of the opportunities that then compensate us for taking those risks. That brings me back down to the role of the state, and often when it comes to looking at China, the overt focus on that role of the state, there's a danger that we tend to miss the importance of private companies towards the state goals. Very, very rarely do we sort of go out and hear just how important the private sector is. In the last few months, however, you've started to see the regulators with a huge change in tact coming out to highlight the private sector value to China's development goals, and this slide shows you exactly why. Now, private companies make up 60% of China's GDP, 70% of tech innovation, and 80% of the jobs out there. So in order to meet this big target, this domestic target that China has of being moderately prosperous by 2035, the economy needs to grow by roughly on average 4.5% a year. And they know that you can't do this with a declining population and no innovation. And China's state-owned enterprises, as we all know, are not really known for their innovation. As a result, private companies play a critical role in China's domestic agenda. And it's going to be important for all of us to watch just how much China balances the state-owned enterprise, the reform of state-owned enterprises, but also the support for private sector innovation in coming years. Going back to that pendulum, just keeping an eye on where that is in the balance. So if I sort of summarize where we get to at this point, some of the big headwinds that we would have been talking about 12 months ago have turned towards tailwinds from a macroeconomic perspective. COVID is a thing of the past. The Politburo have shown themselves to be far more pragmatic when it comes to the economy. and be supportive of private companies. So, China still has its long-term challenges, but when the rest of the world is struggling with rising interest rates, high inflation, cost of living crisis, right now, Chinese households have never been this cashed up before, sitting on huge amounts of excess savings from over the last 3 years and the lockdowns, and interest rates have never been this low. So China's economic recovery this year is likely to mean that it is one of only a few countries where growth actually accelerates in 2023. And that's not a bad starting point for any discussion on China. But at this point, I want to shift tack a little bit away from the big picture discussion about the asset class as a whole and get back to what I think is Baillie Gifford and my comfort zone, which is much more talking about companies. For the China Growth Trust, we believe that the real case for investing in China has nothing to do with where interest rates are, what macroeconomy is doing, how fast the economy is growing. It's really to do with the fact that China is delivering a number of world-leading companies with significant growth opportunities ahead of them. And that's really what our day-to-day focus is on in trying to find exactly those companies. At Baillie Gifford, our research is particularly focused on discovery and not on coverage. So, our focus is very much on the areas that China's trying to turn the taps on. And we're very happy to stay away from the areas where there are much bigger challenges. And I think that's one of the reasons why focusing on individual companies rather than an index is really quite important when investing in China. The good news for us then is that China is still a great place to find high growth companies. Over the last 5 years, 10% of Chinese companies with a starting market cap of $2 billion or more have grown their profits by over 5-fold. That compares to roughly 6% in the US and 6% globally. So for all the big picture discussions, distractions that we talked about, China continues to be quite a rich hunting ground for growth. That can be missed when people are only focusing on one side of the coin. And going back to this idea that, typically when it comes to looking at and analyzing China, that broad generalizations are really quite unhelpful. And sort of hopefully this next slide brings that to life just a little bit more. When many people see China as the world's biggest emitter of carbon, the largest producer and user of cement, highly dependent on coal, therefore in aggregate, really not doing so well on the E of ESG front. We're really focused on the other side of the coin, how China is producing some of the companies that are going to be key to solving the world's climate problems. In the trust, we own companies like LongYi Green Energy. It's the world's largest solar wafer manufacturer. We own companies like CATL, the world's largest EV battery manufacturer. Both are in the Chinese A-share market, the domestic market, Shenzhen and Shanghai, and often not as widely known by those outside of China. Another paradox that we see is really the fact that China is a state-dominated economy, but it's also one which has led to the emergence of some of the most innovative privately owned companies. And we can see, with China now the world leader in things like e-commerce, digital payments, 5G, it looks set to deliver quite a lot of opportunities really in the coming decade in those kind of areas. Maybe it's because of the speed of China's growth and how much it's changing that it shouldn't be a surprise that many people still see China in the rearview mirror. Those historic pillars of growth have been infrastructure, manufacturing, exports. They're the sectors that are often dominated by the state. They're definitely not the poster children for governance and sustainability. But this is changing. We know the government themselves see this as unsustainable, and they're trying to reorient the economy around this as well. And we can see this, more evidently in this slide here, which looks at that transition over the last decade from the old economy to the new economy. So ultimately, China is complex, it is confusing, and there are lots of challenges there. But in some ways, it's also giving us a glimpse of what the future might look like. And for those of us looking forward, and particularly for us 5-10 years forward, we can see a China that is increasingly being driven by new economy, by domestic demand. And therefore, things like consumption, services, technology, and innovation are going to be critical. And they're exactly the areas that we're focused on when it comes to this portfolio. The exciting thing for us around this is almost that opportunity. We talk a lot about the risk, but that opportunity doesn't seem to be reflected so much in investors' portfolios. Despite being the second largest economy in the world, the second largest stock market in the world, and as we've seen, a significant proportion of the growth companies in the world, most global funds have less than 2% invested in China. And I think this slide shows just how much this sticks out like a sore thumb. For those that listened to Ed yesterday, I think the phrase unloved and underappreciated was probably quite relevant here. And I may go one step further, because this is even more stark when we look at China within the MSCI ACWI All Countries World Index. And that index has more money invested in one company, just Apple, in the US than it does in the whole of the China opportunity set. And we think that just isn't right relative to the opportunities that we're seeing. So again, we're not trying to ignore or avoid the risks of investing in China. In fact, we're deliberately trying to acknowledge them and build a portfolio that best positions those opportunities relative to those risks. This seems maybe quite a good point to get back to specifically talking about the growth trust and then those areas of opportunity and the kind of companies that we get excited about. Apologies, I know this is quite a busy slide. It really talks to the opportunities and the areas where we see excitement over the next 5 to 10 years. And I thought I'd try and put some of those opportunities in context. Now, China has a cohort of what we would call next generation consumers, Generation Z, of almost 300 million Generation Z consumers. And these are a demographic that have grown up with a hugely different cultural outlook to their parents. And therefore, the next generation of consumption is really going to have very different drivers to what we've seen before it, particularly in areas like domestic brands and that national focus. And we can't talk about domestic consumption without my personal favorite, without mentioning Baijiu. This is a white alcohol. At an industry level, it sold 10.8 billion liters, which is more than whiskey, rum, tequila, vodka, and gin put together. And few people outside of China ever heard of it. And the only way to get access to those kind of opportunities is in the domestic market. If we start looking at China's scale, we could look at the US, and a company like Grubhub delivers 1 million meals a day, roughly. In China last year, Meituan, the food delivery company, on its peak day delivered 60 million meals. So there are clear benefits to having 160 cities with more than 1 million people when it comes to economies of scale and the ability to support business models and their growth in China versus other places. And if we're talking of scale, we're also looking at data. We can look at the sheer number of users, mobile phone users that China has, and the engagement that its youth population have with their mobile phones. God help anybody with kids, given the average, I think, is 5 to 6 hours a day. But, with China having more 5G base stations than the rest of the world put together, we can see that 3G brought us the likes of Alibaba, Tencent. 4G brings us the likes of ByteDance. What does 5G bring us? And, that's an open question. Autonomous driving, fully automated factories, what else might that bring? And that's why we think it pays to remain curious and to remain open-minded. But these are the reasons why our portfolio is really focused on the upside opportunity here. We like that changing consumption story. We like that China's a world-leading, position in the renewable space and in EV supply chains. We want to align with the top-down drive for things like industrial automation that help overcome China's demographic problem, as well as things like self-sufficiency in tech hardware, which I'll come on to talking about a little bit, because it sort of fits one of the areas you may have come across called little giants. And this is an area where, China is effectively supporting the developed and helping the development of advanced expertise in a whole host of strategic areas. Things like advanced manufacturing, environmental technology, semiconductors. Perhaps interestingly and tangentially, last week we came down to meet with a bunch of academics at the China School at Oxford University, and they were talking about the increasing amount of German advisors to the Chinese government. And I think with the Little Giants, you can see some parallels in terms of that industrial development, particularly with the Mittelstand kind of companies that have done so well in Germany. And these aren't the kind of companies that make the headlines, but they are very much exposed to the kind of bigger picture growth trends that we've already talked about. As of today, and this theme has really been going for 3 years, there's about 5,000 Little Giants. Roughly 400 of them are listed. 84% of them are private. So again, here is an area where the state is helping develop and incentivize predominantly private enterprise. And I thought it might be helpful just to really pick on a couple of the ones that we have in the portfolio to explain, why this is an area that we get excited about. A company called Wuxi Lead is a company that makes winding machines that are really used in the next generation of battery production. And these are machines that tolerate hugely high temperatures. They roll the chemical sheets into battery packs in a phenomenally accurate way. And making and maintaining them is really quite technically difficult. And that's why, or that's certainly the competitive advantage that you have with a company like Wuxi Lead. And because of that technological edge and that leadership, they've become leading suppliers not only to China's largest battery makers like CATL, the world's #1, but also to global battery makers. So in a way, despite flying below the radar, it's companies like this that are exposed to some of the biggest growth drivers globally in terms of the electrification of vehicles, and that's what excites us. Then I might pick under the hard technology side here of SG Micro, which is an analog chip designer. And very simply, analog chips just convert sort of real-world signals, temperature, pressure, sound, into digital form. And as a result, these chips are absolutely everywhere. They're not the most modern technology. But the domestic opportunity here is arguably one that benefits from the geopolitical problems and challenges that China is going through. If we think of one of China's biggest import bills, even bigger than oil, is semiconductors. And what we see is really this shift, or this idea that China is very keen to increase self-sufficiency in this space, and SG Micro is helping it do exactly that. It's opportunities like SG Micro that highlight to us that successful investing in China requires finding the small number of companies with this long-term vision, with that growth potential, but that are also aligned with government policy and the goals of the state. Trying to sort of put all of this together, what we have in the trust is a portfolio of roughly 60 companies that, reflect what we think are the best growth ideas, regardless of where they're listed. And we're quite happy to own things, regardless where they're listed, what their size of the market cap, or whether they can double. That's our key driver, where they can double over 5 years. We think it's also important that as much as what you do own in China, it's what you don't own. And therefore, we have very few investments in things like property, in the financial space, and in energy, which we know are very large parts of the index, but they certainly wouldn't meet our growth portfolio. I know that Thomas has popped up, which either means I'm over time or that there are plenty of questions coming on here. In the appendix to the presentation, we've got quite a lot on our team, our philosophy, on ESG, on risk, but I will probably stop there just to see what the questions are, and then happy to deal with any of the other areas if questions are there.
Brilliant, thanks, Ben. Yeah, we do already have quite a few questions, but if you're in the audience and you have a burning question, please do pop it in there. We've got 15 minutes or so. We'll try and answer them all. Perhaps we could start with something you mentioned briefly, Ben, renewables. So China's obviously investing quite heavily in renewables. Could you just tell us a bit about what percentage of NAV in the portfolio is invested in this area and any particularly exciting holdings?
Yeah, we're probably, if you think of some of the companies like, CATL is sort of roughly 2%, Longi Green Technology. So, we're probably, Sungrow Power is another one, which is in inverters. So we're probably pushing sort of 5+% in this area that are specifically in what we'd call the new energy space. We also have companies like ENN and ENN Energy, which have actually been in the portfolio since 2008. From our broader all China strategy, that again tangentially have links here. But the excitement for us, I mean, I could take CATL. It's probably now the more renowned one because of its market cap is now getting into global portfolios. But this is one that we've probably looked at now for sort of 5 or 6 years. And it had sort of got into the broader China portfolios 4 years ago as it was starting to develop its technology. But as the global leader now, not only supplying Chinese domestic OEMs, but companies like Tesla and Volkswagen internationally, we can roll forward to 2030 and see a time where you're going to have 50 million EVs produced every year. Being 40% market share would give you 20 million EVs, and even if costs per battery come down to $5,000 a battery, there's $100 billion of revenue just in that business alone. That company grew its earnings 93% last year, and management come out and said, what we get most excited about is not the battery business, it's the energy storage solution business, which is the second arm of their business. And I won't go into that here, but they think that could be even greater. So there's an example of what is already a world-leading company with significant market share that sometimes flies under the radar, but one we think over the next decade can continue to drive that sort of climate change development globally, not just in China.
Great, thanks. And a question more on the portfolio as a whole. What's the valuation of the portfolio like at the moment versus the market? So the questioner has said average PE and distribution. But how do you think about the valuation? Is a PE what you would look at? How would you think about it in terms of how it looks versus the market?
Yeah, so hopefully you can see this slide, which will show exactly what it is we're trying to focus on. So the portfolio itself has far higher growth and forecast earnings growth than the index. We are typically going to be higher in terms of valuation than the index. We tend not to look at things like 1-year PEs. If I go back to that example of CATL, we're looking to 2030 to the kind of scale that this business could be. And therefore, short-term PE multiples may, in some instances, disguise that future opportunity. And therefore, we are happy to look through short-term PE ratios where required to do that. That's clearly not the case with the whole portfolio. And there are things like China Merchants Bank that's on 5 times earnings. If we look at some of the largest internet companies now, things like Tencent, Alibaba are exciting for the fact that their core earnings are sort of 8-9 times earnings. So there's sort of slight difference within the portfolio, but in aggregate, we will typically be higher growth, higher in terms of quality when we look at returns on equity. Our portfolio is net cash relative to an index which is roughly 20% geared. And that's very typical of what you should expect from a Baillie Gifford China portfolio.
Yeah, and we had a follow-up question about the CAPE, the cyclically adjusted PE. I don't know if that's something you have to hand, but I guess the question, to be a bit more vague, perhaps a bit more friendly question to you. How does China's valuation currently stand relative to recent history? Is it over or undervalued versus recent history?
So I'll be going beyond my sort of comfort zone as a sort of bottom-up fundamental guy here. I mean, on the whole, if we look at Chinese indices, they are far cheaper, both than global indices. Sort of US is now sort of 16, 17 times, China's 11 times. The A-share market, which has historically been far more highly valued, is now down around that 11 times as well, and therefore historically far cheaper than it has been in the past. So as a counter to my own discussion of, broad generalizations can be unhelpful. In aggregate, yes, Chinese indices look far cheaper than they have historically, and that is an added bonus when coming to think about how to look at China. But for us, it wouldn't be one of the critical ones. We get back to the nature of the companies that would be most critical.
And you touched on the profitability on a portfolio level. What percentage of your portfolio is unprofitable? Are there any kind of pre-profit companies in there?
A very, very small amount, and less than 10% would be, off the top of my head. We have had some of these companies in the past, like Bilibili, which we sold fairly recently just for that competitive threat with the likes of companies like ByteDance, who are now far more profitable. So in general and direction of trend, the majority of these portfolios are, absolutely profitable. And as a broad discussion of where we've been moving more into A shares over time. That proportion now, as you can see on this slide, is 41%. That probably would have been less than 20% 2 years ago. And with that, moving into more sort of industrial companies that fit that industrial automation, self-sufficiency, import substitution drive that we talked about a bit earlier on. And obviously they are clearly, both, clearly revenue growth potential, but also significantly profitable.
We do have a few more macro-focused questions, which I will certainly move on to, but perhaps a final one on the portfolio for now. Obviously, it's been quite a volatile period. How has portfolio turnover been? What is it typically, and has it been any higher as a result of the market movements we've seen?
Yeah. Typically, this is a broader philosophy one, but I'll answer the turnover. Turnover currently now, 12-month turnover is less than 10%. Perhaps unusually, given all of that sort of volatility and discussion last year, we did very little. In Q3, we had no new buys, no sales. In Q4, we bought 2 new A shares and sold 5 companies where we felt that either the business outlook had changed, or we were consolidating into higher conviction names, particularly in the healthcare space, given some of the headwinds there. So we would suggest that given our holding periods and our horizons are roughly 5 years, that 20% is where we should be. We've been slightly below that because we quite like the kind of companies we have in the portfolio. And when we look at the fundamental growth of each individual company, it hasn't required us to make significant changes. But where opportunities from share price volatility has come, we've certainly added and made reductions in certain areas. We would expect that 20% over the medium term, but right now just under 10% on a 12-month basis.
I guess one of the sources of that volatility has been the war in Ukraine, and as a response to that war, we've seen some quite severe sanctions on Russia. There have also been various sanctions placed on China during the same period. How have those affected investment, if they have at all? How do they affect the companies that you look at, or any assessment you make of the likely future?
Yeah, I think there's sort of 2 approaches, because sort of 18 months ago, just sort of when Biden came into office and sort of cemented really the sanctions list in the US, that was sort of pre anything to do with Ukraine. So we'd already been dealing with, to some extent, this overarching US geopolitics in which companies that were potentially supplying what was sort of what's called the sort of military and industrial complex. I think it started with a list of 59 companies. That's where the sanctions came. At the time, we did invest in one of those companies, which was Hikvision, the world leading CCTV manufacturer. Fundamentally, that then affected their overseas growth profile, and we sold that based on simply an inability for them to maximize that international plan that they had. But it really is very much at the edges, and there's nothing in the portfolio today that would be close to that. The Ukraine element, I think, has taught China a few lessons in having to be cautious around how it might approach things like Taiwan, because the unified response from the West has clearly started causing Russia some significant problems. But China's got a tricky balancing act here, because it could potentially be the savior and the country that is able to broker a deal with Russia. And it'll be interesting to see what comes out of certainly today's meeting. The belief is that the 4-hour one-on-one that she had with Putin yesterday was where the real decisions were made. So there is an element where China may well be beneficial in a global context here, but there's a very big wait and see on that side of things. I guess the benefit of running a portfolio of only 60 stocks when you've got 6,000 to choose from is that we can try to avoid these kind of issues where the risk is heightened by geopolitical challenges, where supply chains or concerns about that ESG element are greatest, is where we can just quite happily avoid, because fundamentally those negative externalities are going to change our appreciation and expectation for the long-term sustainable outlook of these kind of businesses. So at the edges, we need to be aware of what's going on. We'd say we've been looking at this for 2 or 3 years since the sanctions had come in, but from a portfolio context, there's nothing that worries us as of today. That will need to be looked at on a dynamic basis.
Maybe I'll give a last call for questions. We still have quite a few to cover, which we'll try and bring this to a close in 4 or 5 minutes. So I'll try and wrap a few questions together. Firstly, we had a question on real estate. You did mention that it's not really an area that you invest in a lot, but we have a question about what impact the issues of leverage in real estate sector might have on the formal and informal banking sector, and is that still a live risk?
Again, sort of this pulls us back into that macro, and it's sort of easy to say from a portfolio perspective, we own none of the state-owned financials. We don't have any direct property holdings in there for the reasons that we think there are still challenges to growth. And those debt problems, the local government financing, that system of land sale, they are headwinds to, certainly to individual company investments, but to some extent also to the economy. However, we've been talking about risks in the property sector for years and years and years for those that have looked at China, and to some extent the role of the government and the ability to take money out of one pocket and put it into the other to help support this is really what is most critical. And what we saw at the end of last year was a true recognition of where the problems lie, and the government coming to the help of both the local government finance side of things and the property. So we still think it's challenged. We're still happy to not be involved, even though they're significant parts of the index because of the headwinds that are there. But at a macro level, there's some comfort that the government is starting to deal with these challenges and release these sort of 3 red lines in order to help support that. If anything, if it forces consolidation within the sector towards the better run, better capitalized, and that's probably a good thing.
We have a question on the little giants companies that you referred to. It's quite interesting. So the question is, will the little giant companies' valuations reflect their true worth without appropriate foreign investment? Will valuations ever match an equivalent US listed company?
Great question, and I doubt there is a definitive answer. I think in the small area of little giants, the answer is yes. If you think of the Chinese economy very quickly, you have a hugely capitalist, very innovative private element. You have the key factors of production at the top, energy, telecoms, infrastructure that are run by the state, and a mixed layer in the middle. And as we've seen, as you get bigger in that mixed layer and become more dominant, like Alibaba and Tencent, the greater role the government have in your business. For the little giants, many of these are really still very small, but with key parts of technology that help in that industrial space. So there is plenty of room for them to grow before they start becoming a risk to the state. And actually, for something like CATL, it's almost beneficial for the state to have a national champion in that area. So, to some extent, yes, therefore, valuation should be able to reflect that. I think the bigger challenge is just that the A-share market is very, very driven by the domestic retail investor, and therefore momentum becomes important and fads become, at times, in the short term, quite important. So I would come back to that answer and say, actually, what we need to monitor is just how the momentum starts to push valuations ahead of fundamentals, rather than the other way around.
A couple of questions on corporate governance that tie together. So one question regarding the golden shares that exist from the Chinese government in various companies. does that, how does that affect valuation and the ability of shareholders to invest and control the share price? And then another one, perhaps more general, about how corporate governance differs from here, and how that how you have to take that into consideration when you invest.
Yeah, very important questions when it comes to China, for the fact that China is different. It's very interesting for me, and this is somewhat tongue-in-cheek, but looking at UBS and Credit Suisse, where the regulators have come in and ignored Credit Suisse shareholders to do what they want to do without needing to own 1% of the shares to do it. But clearly in China, the element of golden shares has been portrayed as the state having a far greater influence in the decision-making of private companies. What we've seen at the moment is it's only with 5 companies, and it is very specific to media content. And they're not coming in and buying 1% of the listed company and taking seats on the board for decision making at the board. They're coming into the unlisted subsidiaries that are the media element, and then trying to monitor that. Now, because this is new, and because they're in the unlisted subsidiaries typically, they're not very transparent at all, and therefore trying to get any insight into how they are being enacted is really quite tricky at this stage. But I think we would just focus on its understanding content and who is driving that media content, and we'll just have to wait to see really what kind of impact that has at the broader level. But to date, it's really too early to say. Given that it is really very small, I think it has been overblown so far. But again, something that is a challenge that we need to watch. Corporate governance, in short, in China, in aggregate, is really pretty poor. If you think of that domestic market, which is 96% domestic owned, 85% is retail, you don't have a drive for long-term thinking. The average holding period is 5 months. And if that's the case, you don't care about who the management is, what the long-term vision is, how you align with your stakeholders. You want to get your money and run. Those of us that have looked at China for 20 years will start to see that China is really making big changes in this space. The legislation for the listed companies is changing. Baillie Gifford, chief executive, our senior partner, was presenting in Beijing at the weekend to the regulators on how long-term thinking makes a difference to domestic asset management industries and things like that. So there is a desire and a willingness to want to develop. But we shouldn't forget that the starting point here is one where 2,000 of the 6,000 listed companies are state-owned. They're much more likely to be beholden to the state. They're not run by professional profit maximizing professional managers. And I wouldn't want to cast the same net on every single one of them. There are clearly different cases here. But it gets back to this idea of you need to focus on individual companies. You need to ask those long-term questions about stakeholder alignment and understand what the management incentives are that are behind that. And that's really what drives us here in the trust.
Thanks, Ben. And one final question, I promise, and then we'll let you have some lunch. I'm afraid it's not an easy question. And a couple of people have highlighted that obviously we've had a sharp run up in Chinese shares in the last couple of years, and then an equally sharp decline, almost a round trip. And a couple of people asking separately, I suppose, what does this mean about the gains that were made during that time? Were they illusory, so to speak? And I guess an even harder question to answer, looking forward, what will lead us to turn around? Can we still expect good performance from China of the like that we've seen in the past?
Yeah, and I think, in very short term, you've had what was a phenomenal 2020 in which the growth of the new economy, digital stocks, e-commerce, food delivery and things were really accelerated by COVID. And then the continued lockdowns that China saw for the following 2 years, aligned with negative headwinds of regulation and things like that, were big challenges to returns. Now, that didn't change the operating environment for a number of these companies that continue to grow very strongly through that. But this perception of China geopolitically in particular has meant, I think, that a lot of foreigners have tended to say, okay, here's my red line, here are the challenges, I'm taking a step away from China. As I said, that market is quite fickle, because last year it was China's uninvestable, all the questions were about the risk. Suddenly now it's like, well, what about China's recovery that's coming this year? So if we try and disentangle what is structural from what is cyclical, a lot of what we now expect from this year is a recovery of China's economy. The headwinds have shifted. The corporate environment continues to be supportive of growth, in fact, more so than the last 2 years, because the Chinese government are now supporting private companies, removing regulation. My caution is not to get carried away, because the fundamental underpinnings of the Chinese Communist approach of common prosperity, of dual circulation, will still be there in 5 years. The demographic problems will still be there in 5 years. But so will the need to solve those problems with innovative solutions and private companies. So, our expectation, or at Baillie Gifford, our focus is purely on making sure that the companies we're invested in this trust continue to be able to deliver that 15% annual growth over a 5-year period, and believe that share prices will take care of that if that's what we focus on. I think the market will focus much more on things like geopolitics, on Taiwan, on growth. But as you saw in November, December last year, that as foreigners start to come back into the market quite quickly in anticipation of that recovery, things can move really quite quickly.
Fantastic. Well, thanks very much, Ben, for your presentation and for answering all those questions so well. Thanks to all of you in the audience for your attention and your questions. Before we leave, just a quick reminder that on Thursday, the next session will be with the managers of Ashoka India Equity, talking about India. So finally, Ben, one last time, thanks very much for your presentation. It was good to speak to you, and have a good afternoon.
Thanks for having me. Thanks, Thomas. Thanks all.
Bye-bye.